by Jane Smith and Andrew Smith
We don't own the rights to
with
the
an account
background,
balance
all
of
rights to the background.
$400,000. Our second account has Jane Smith as the owner, with Harry Jones as the. The second account has a balance of $200,000. So, are all of the owners fully insured? In calculating the amount of deposit insurance coverage, we have to look at each owner's interest in all joint account deposits. Remember, there is a presumption that each person has equal ownership share of the funds. So when looking at our example, we have account number 1, Jane Smith and Andrew Smith, as the co-owners of the account, with a total balance of $400,000. The individual ownership interest for each owner under account number 1 is 1/2 of $400,000, or $200,000 for Jane and $200,000 for Andrew. For account number 2, we see that the ownership interests are $100,000 for Jane and $100,000 for Harry. In looking at the column for Jane Smith in this example, you see that Jane Smith has a $200,000 ownership interest in the joint account category for account number 1 and a $100,000 ownership interest for account number 2. When we add Jane Smith's ownership interest together for both of these joint accounts, she has a total of $300,000 in the joint account category. Now, the most that any one person can have insured in all of their joint ownership deposits together is $250,000 per bank. And therefore, since Jane Smith has $300,000, she is uninsured for $50,000. This example shows that in calculating joint account coverage, a depositor's ownership interest in all joint account deposits must be added together in determining how much insurance coverage they can have under Category 2 joint accounts. The key point to remember from this example is that while Jane Smith did not have an ownership interest of more than $250,000 in any one joint account, her combined ownership interest in multiple joint accounts totaled $300,000, and that resulted in her having $50,000 of uninsured funds. On this slide, we will look at an example of the impact of the death of an account owner and the application of what we described on slide 12 as the 6-month rule. Let's assume John and Jane Smith had opened $500,000 on January 1st, 2013. John dies on March 31st, 2013. What is the deposit insurance coverage for the account now that John has died?
This is a banking class.
The answer is that for the 6
Then you know
months
what type of deposits
death,
we could do.
assuming that the
250,000.
account remains open and Jane does not retitle the account will continue to be insured for $500,000.
Joint accounts, you and your girl, or you and somebody else, is $500,000.
6-month grace period, assuming the account has
250
not
for
been
each.
restructured. Beginning October 1st, 2013, Jane would have $500,000 in Category 1 single accounts, with $250,000 insured and $250,000 that would now be uninsured. One of the most popular categories of deposit insurance coverage that is available to individuals is Category 3 revocable trust accounts. Before I discuss the rules for revocable trust deposits, let's start with defining these types of accounts. For the purpose of eligibility under Category 3 revocable trust accounts, the deposit must be a legitimate testamentary account. The term testamentary means that in establishing the account, it must be clear in the bank records that upon the death of the owner or owners of the deposit, the deposited funds will then be transferred to one or more named beneficiaries linked to the account. For the purpose of FDIC deposit insurance, the term revocable means that while the owner or owners of the deposit account are alive, they are reserving the right to change who will be the beneficiary or beneficiaries of the funds. and they are also reserving the right to change or revoke the amount of money that each beneficiary will receive when the owner dies. For our discussion today, we will address the types of revocable trust described under the FDIC regulations. The FDIC recognizes two forms of revocable trust deposits: informal and formal revocable trusts. One of the most important questions we have to answer in determining deposit insurance coverage is, who are the beneficiaries of the trust? In other words, when the owner of the trust passes away,
Your children and
who
stuff is
has
like
he or she designated to
beneficiaries.
receive the
Whoever you
trust
want
assets?
to get your
For
assets
deposit
once you
insurance
pass away.
purposes, a beneficiary must be an eligible beneficiary. The definition of an eligible beneficiary has been expanded to include any natural person or either a charity or nonprofit organization recognized as such by the IRS. This means that an owner can now name any living person as a beneficiary, even if they are not related. And in addition, any charities or nonprofit
Somebody you met
organizations
along the way in
named as
life, they might have
beneficiaries
done something
that are
good
valid
for you. You might
organizations
want
under
to give them
IRS
something.
rules
That's
would
your
also be
beneficiary.
considered eligible beneficiaries. Okay, we're going to discuss a question that we are repeatedly asked by bank employees. Does POD, or payable in death, or a similar term conveying testamentary intent, have to be in the account title of an informal trust? The answer is yes, but since October of 2009, banks can easily meet this requirement using their electronic record keeping. The revised rule provides that the FDIC will recognize a deposit as an informal revocable trust account, provided that the bank's electronic deposit account records designate the account as a payable in death account. For
Revocable,
instance,
you
this
can always
designation
change
can be
it.
made using a code in the
Irrevocable,
bank's
once you put it in there, you
electronic
can't
deposit account
change it.
records.
It'll be like your property,
In
maybe.
addition to determining who is an eligible beneficiary and meeting the titling requirements, there are two other important questions to answer to calculate deposit insurance coverage for a revocable trust. Depositors and bankers must ask how many beneficiaries are identified by the owner and whether those beneficiaries are to receive equal or unequal allocations
Me
when the owner of
personally,
the
I
trust
have
deposit dies.
3 heirs, 3
This is a
offsprings.
two-part rule which will help us answer those questions.
One
We'll
like step
discuss the first part of the rule
Yeah.
on this slide
or
and the second
offspring.
part of the rule on the next slide. The first rule concerns revocable trust accounts with 5 or fewer beneficiaries. Assume we have an individual who wants to establish a Category 3 revocable trust deposit, naming 5 or fewer beneficiaries, and the total combined for all their trust deposits will be $1,250,000 or less. If the owner has named 5 or fewer beneficiaries, then the amount of deposit insurance coverage is equal to up to $250,000 times the number of beneficiaries named by the owner. But what if the owner has named 5 or fewer beneficiaries and the percentage or dollar allocations to multiple named beneficiaries is unequal? When 5 or fewer beneficiaries are named, we will ignore the unequal allocations. Under the rule, if you have named 5 or fewer beneficiaries, then regardless of the percentage or dollar allocation to the beneficiaries, you simply multiply the number of named beneficiaries times $250,000, and that is the amount of deposit insurance coverage that will be available. Now we will discuss the second part of the rule, which concerns trust deposits with 6 or more
New
beneficiaries.
study session, banking.
Let's assume we have a depositor who has named 6 or more beneficiaries and wants to deposit more than $1,250,000. How do we calculate coverage? Well, if the owner has named 6 or more beneficiaries and the allocation is equal to each beneficiary, it's easy. As before, we are simply going to multiply $250,000 times the number of eligible beneficiaries named. So, for example, if there are 6 beneficiaries receiving equal percentages or allocations, 6 times $250,000 results in up to $1,500,000. If there were 7 beneficiaries, 7 times $250,000 would be
We got all them little girls and boys that's on your line.
insured coverage.
By 6 is
But when
150,000.
more
150 million.
$250,000 has named 6 or more
Eugene,
beneficiaries.
you got about $3
under
million.
revocable trust deposits. What has
250,000 for each one of your
dollar
offspring.
amounts allocated to the beneficiaries. This is a bit tricky. The reason is the rule for 6 or more beneficiaries named with unequal interest is different than the rule for 5 or fewer named beneficiaries.
Well, my bad. You about to tell you now, 6 or more
An
is
owner
different.
who has identified 6 or more beneficiaries with unequal interest is insured for up to at least $1,250,000.
$1,250,000.
If you have questions regarding a revocable trust account naming 6 or more beneficiaries with unequal interests, please contact the FDIC toll-free at 1-877-275-3342 and ask to speak
They
to a
even give you
deposit insurance subject matter expert.
the number. And they help
For the
you
next
get your
2
stuff
slides,
to
we're going
his
discuss one
best
of the most common
interest.
misconceptions that we encounter, and it concerns the question of how to calculate coverage for revocable trust accounts. We will begin with the scenario of one owner of a payable and death account and one beneficiary. There is a misconception that deposit insurance coverage is calculated by adding the number of owners and the number of beneficiaries on a payable and death account. This is incorrect. To explore this issue, let us look at the first example, where we will assume that John is opening a payable and death account, naming Lisa as the beneficiary of the deposit if he predeceases her. Assuming this is the only revocable trust account John has at this bank, what is the maximum insurable amount of deposit insurance coverage for this account? Herein applying our formula for 5 or fewer beneficiaries, we will simply multiply the total number of owners times the total number of beneficiaries times $250,000. In performing the calculation, one owner times one beneficiary times $250,000 would give us the result of $250,000 as the maximum insurable amount. This example illustrates perhaps the single biggest misunderstanding we hear again and again in calculating FDIC deposit insurance coverage for revocable trust deposits. The misunderstanding or confusion is that depositors want to allow $250,000 for John plus $250,000 for Lisa for a total of $500,000. This is not correct. Please remember, unlike Category 2 joint accounts, where every individual listed on the account is an owner and entitled to up to $250,000 in deposit insurance coverage, the rules for revocable trust accounts are different. The key point is that coverage is determined by taking the number of owners times the number of unique eligible beneficiaries times $250,000. On this slide, we will explore a second misconception regarding deposit insurance coverage for a payable and death account with one owner and 2 beneficiaries. As you can see, there is one owner and 2 beneficiaries. This graphic illustrates one of the most common questions that we receive from both bankers and depositors. If there is one owner and 2 beneficiaries on a payable and death account, shouldn't the coverage be $750,000? And the answer is no. That is incorrect. Remember, to determine deposit insurance coverage, we take the number of owners and multiply it times the number of beneficiaries and multiply that times $250,000. In this example, the calculation is one owner multiplied times 2 beneficiaries multiplied times $250,000, which results in $500,000 of deposit.
They're telling us how much our bank account is going to be secured
coverage is
in a different type of account.
not $750,000.
Like single is 250, joint is
We have
500,
now concluded our
and
brief
the trust
discussion
is
on
no
revocable
different.
trust accounts. Next, we will discuss our fourth category available to individual depositors, irrevocable trust accounts. So, what does irrevocable mean? For the purpose of applying FDIC deposit insurance rules, irrevocable means that the grantor, in other words, the person who created the trust, does not possess the power to terminate or revoke the trust agreement. How is an irrevocable trust created? An irrevocable trust can be created through the death of a grantor of a living revocable trust or the actual execution or creation of an irrevocable trust agreement or by statute or court order. An irrevocable trust deposit must be linked to a written trust agreement. You cannot create an irrevocable trust deposit by using POD or ITF in the account title. And let us emphasize that irrevocable trusts are far less common than revocable trusts. Most of the irrevocable trusts you will encounter will be the result of the fact that the owner or owners of a revocable trust account agreement have died. Unlike Category 3 revocable trust accounts, where the coverage can extend beyond the SMDIA, irrevocable trust coverage is usually limited to no more than $250,000. The rules for irrevocable trust deposits have significant differences from calculating deposit insurance coverage for revocable trusts. There are several important issues to consider when calculating deposit insurance coverage for irrevocable trusts. The first important issue is if the grantor of an irrevocable trust is alive and the grantor has retained an interest in the use of the trust assets during their lifetime, then to the extent there is a retained interest, these funds will be insured as Category 1 single ownership account deposits, not under Category 4 irrevocable trusts. The second issue to consider when calculating coverage for irrevocable trust deposits is contingent interest. To the extent funds are allocated to one or more contingent beneficiaries or beneficiaries with contingent interest, then these interests are added together and the combination of all contingent interests are insured for up to $250,000. Examples of situations that create contingent interest include: 1. Does the irrevocable trust agreement provide that one or more beneficiaries will not receive some or all of their designated bequests unless certain conditions are satisfied? 2. Does the irrevocable trust agreement provide that a trustee may invade the principal of the trust with the result that the funds available for the other beneficiaries may be reduced or eliminated? An example of this would be a provision allowing a trustee to invade the trust for the support or medical needs of a surviving spouse or a beneficiary. 3. Does the irrevocable trust agreement provide that a trustee may exercise discretion in allocating assets among the beneficiaries with the result that the future distribution to each beneficiary is impossible to predict? We have found that almost all irrevocable trusts that start as revocable trusts will have at least one of these contingencies. The third issue to consider when calculating coverage for irrevocable trusts is that if the beneficiary's interests are non-contingent, then there is pass-through coverage for each beneficiary up to $250,000 based on each beneficiary's specific allocation. We have now completed our discussion of trusts. Our fifth category of deposit insurance coverage
Just
for an
coming
individual
straight off
was
the
created by statute
FDIC
in
YouTube
2006
channel.
and is described under the statute as certain retirement accounts. To begin, this category pertains to deposits that are typically owned by only one participant, with the funds representing a self-directed retirement account. Second, for eligibility under this category, the retirement plan must be self-directed unless a specific exception is described. That means the participant must direct the investment of their interest in the plan assets. If the investment decision is made by a plan administrator, then the deposit is still insured by the FDIC, but the amount of coverage is calculated using rules under Category 6 Employee Benefit Plan accounts. Third, the account must be titled in the name of the owner's retirement account. For example, individual retirement accounts, or IRAs, are the most common example of certain retirement accounts, and the account needs to be opened with IRA in the title. And finally, the coverage for Category 5, certain retirement accounts, is a maximum of up to $250,000. While IRAs are the most common form of self-directed retirement plans under this category, it is important to recognize that self-directed defined contribution plans are also included. A common misunderstanding about retirement plans insured under this category is that adding beneficiaries will increase coverage similar to deposits that are revocable trusts. This is incorrect. For deposits under this category, such as IRAs, the maximum deposit insurance coverage, even if beneficiaries are named, is up to $250,000 for the participant. Please note that all defined benefit plans are excluded from this category, as well as any defined contribution plan which is not self-directed. We will now discuss the last ownership category available to individuals. If your depositor has an employee benefit plan but does not meet the requirements of Category 5, certain retirement accounts, we will then look to Category 6, which is simply called the Employee Benefit Plan Account category. Under Category 6, the account title must clearly indicate the existence of an employee benefit plan, and the plan administrator must be prepared to produce copies of the plan documents. Assuming these requirements are met, the amount of deposit insurance coverage is up to $250,000 for each participant's non-contingent interest. The types of employee benefit plans covered under Category 6 include defined contribution plans that are not self-directed. And as mentioned previously, all defined benefit plans are insured under this category. As a reminder, Category 6 employee benefit plan accounts are fiduciary accounts that must meet the requirements for pass-through deposit insurance coverage to be insured in this category. We now move from the 6 categories for individuals to the 1 category that applies to business entities. Category 7, business organizations, includes corporations, including Subchapter S, LLCs, and professional corporations. Also included are legally created partnership entities and unincorporated associations. Coverage for business organizations is up to $250,000 per legal entity, provided that the entity is engaged in an independent activity. This means the business entity must have been formed for a business purpose and was not created for the sole reason of increasing FDIC deposit insurance coverage. Our 8th ownership category is titled government accounts, or sometimes they are referred to as public unit accounts. As with business entities, there is only 1 category that applies to government accounts. So, what is a government account? A government account is a deposit placed by an official custodian of a government entity, including federal, state, county, municipality, or a political subdivision. Who is considered an official custodian? An official custodian is an appointed or elected official who has plenary authority, including control or decision-making authority over funds in the account owned by the public unit. Coverage for this ownership category depends on the type of deposit and the location of the bank. For Category 8 government accounts, deposit insurance coverage is at least up to $250,000 per official custodian. Based on the regulation passed in 2008, the 9th category of deposit insurance coverage pertains to mortgage servicing deposits for principal and interest, or P&I payments. This category concerns accounts established by mortgagees or lenders and represents commingled P&I payments received from borrowers. The rule for Category 9 mortgage servicing accounts provides that commingled P&I payment or P&I accounts established by mortgagees or lenders are insured with coverage provided up to the SMDIA of $250,000 per borrower. This coverage is provided to mortgagees or lenders as a collective group and is based on the borrower's payment of principal and interest. Funds qualifying under this category are not added with any other deposits that the borrowers may have at the same bank. We have now completed our discussion on the fundamentals of deposit insurance coverage. Before describing some important deposit insurance resources in our last section, we want to take just a few minutes to review some of the main points that we have covered in our discussion today. Here in slide 52 and slide 53, we have identified 10 items to remember about deposit insurance coverage. Number 1, deposit insurance coverage is provided per depositor, per ownership category, per bank. Number 2, at the same bank, a depositor can be insured for more than the SMDIA if they own accounts in different ownership categories. Number 3, separate coverage is provided to depositors for separate account ownership categories. Number 4, all accounts owned by the same depositor in the same ownership category at the same bank are added together and insured up to the SMDIA. Number 5, deposit insurance coverage is up to the SMDIA and includes principal and accrued interest up through the date of the bank's failure. Remember, to be fully insured, the principal and accrued interest combined must not exceed the SMDIA. Number 6, deposits owned by one or more individuals that identify payable and death beneficiaries are insured as revocable trust accounts on a per beneficiary basis. Number 7, a payable and death account with one owner and one eligible beneficiary is insured for up to $250,000, not $500,000. Number 8, adding beneficiaries on an IRA does not increase the coverage because certain retirement accounts, such as IRAs, are insured for up to a maximum of $250,000. Number 9, to check your deposit insurance coverage, log on to the FDIC's ED calculator at www.fdic.gov/EDIE. And finally, number 10, if you have any questions about deposit insurance coverage, call the FDIC at 1-877-275-3342. Part 4, deposit insurance coverage resources. In addition to today's presentation, the FDIC is offering 2 other seminars which cover a wide variety of topics. As you will see on the left side of this slide, in 2016, the FDIC will offer a seminar exclusively on revocable trust accounts, covering complex scenarios, including in-depth examples for revocable trust accounts with more than $1,250,000 in deposits and 6 or more beneficiaries receiving unequal interests. On the right hand of the slide, you will see that we are also offering a seminar covering advanced topics in deposit insurance coverage. This seminar will discuss government accounts, mortgage servicing accounts, bank mergers, and pass-through deposit insurance coverage, as well as other deposit insurance topics. The FDIC's website, located at www.fdic.gov, is an excellent resource for bankers, as well as any depositor or other interested party who is looking for information about FDIC deposit insurance coverage. The FDIC is constantly updating this website with current deposit insurance information whenever there is a statutory or regulatory change affecting deposit insurance coverage. Among the resources most accessed is the FDIC's Electronic Deposit Insurance Estimator, or EDI, which is an excellent tool to help calculate a depositor's insurance coverage based on either existing accounts in a bank or to check the amount of potential deposit insurance coverage that may be available based on a hypothetical scenario. In addition, the FDIC has written a number of deposit insurance guides available both online as well as hard copy. These include Your Insured Deposits, which is also available in a large print version. These brochures and other resources are available on the FDIC's Deposit Insurance Coverage webpage. If you are interested in ordering deposit insurance materials, including our brochures, videos, or FDIC signage, please go to the link provided on this slide and visit the FDIC's online product catalog. These materials are all available free of charge. The FDIC also offers computer-based training on deposit insurance for bankers. This user-friendly, self-paced training tool will assist bankers in understanding